Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Wednesday. It is the 9th of June. It is the second week and the third trading week of the second. It is the third day and the second trading week of June. And it is our first full week in June where the markets don't have any days off, which is very, very big because whenever you have one day off, it's a fragmented week, and then pretty much the whole week is just choppy and sideways like a vacation holiday because fund managers love to take time off. I know I was one of them. Markets are fairly mixed right now. There's really not much going on. I do want to note that on Friday afternoon, Monday, I talked about a 1 month high in the bond market. I explained that a high in the bond market could cause a rally in the tech sector. We've seen a little bit of a rally in the tech sector, and they're opening up a little higher. And the bond market right now, if we look at the bond market, which we will in a few seconds, you will see that the bond market's not at a 1 month high, but the bond market's actually at almost a 2 month high, about a 7-week high right now. And if we break higher, it's going to go. Also, on that note, the XLK sector, the technology sector, is breaking out as we expected. Hopefully, this will test the old high. Don't expect a huge rally. We're not going to expect it. Markets are overbought. Also, I want to show you something that's cautionary right now. Put to call ratio. Now, when we get a level of 65.65 or lower, that means there's too much call buying. There's too much bullish activity. When we get above 1, that means the market is getting too bearish. Too much fear is coming into the market. But this is telling us there's too much greed coming into the market. And what it really means is we shouldn't be expecting too much upside. Also notice right here, the price action has been really choppy, sideways. It's moving higher, but it's having a rough time. It's like a rubber band that's stretched out. Well, that has a lot to do with the put-to-call ratio, and that also has a lot to do with momentum levels, which I'll show you really quick aren't doing us any favors. Let me just kind of quickly go through this. So even though I'm expecting some upside in the market, it's limited. Don't expect a massive rally where we're going to double in size right now. I'll show you this real quick as I'm going through this. But this is the momentum chart, and we're really on the hook right now. And that's the 200-day. If you look at the number of stocks above the 50-day line, it's not going to look much better. And I know I show this to you all the time. It's moving lower, as you can see here. So momentum levels are declining, not ascending. And when you take that with the put-to-call ratio, and you may want to watch this video a few times because I'm kind of going through it pretty quickly, but if you rewind it and watch it a few times, or if you watch my videos daily, you'll have a really good understanding of what I'm talking about. It's crucial, and we've been right on target. So again, markets are a little complacent. Doesn't mean we're going to have a major pull-off. It just means we may remain choppy with a little sideways bias in the S&P, in the SPY. Now, in terms of, that's right here. In terms of the SPY, this listless trading action may persist. Now, in terms of the QQQ, and this is going back to the conversation that I was having a few minutes ago with you. See this breakout we're having? We're now having 3 days actually above the 50-day line. And I think we're going to go higher. I think we're going to go a little higher, maybe take out all-time highs because of the relief we are seeing with the bond market. Because here's the thing, and I want to explain this again to you because this is very important. Bonds going higher, which means lower interest rates. Lower interest rates means there's potential to make more money from tech stocks if they go up because techs give more volatility. And we're also seeing the same thing with small caps. Small caps are seeing a little bit of a breakout as well, which I called right here. This is because of the bond market. So lower rates, better for stocks, less pressure on stocks, specifically small cap stocks and tech stocks. But remember, the S&P 500 has 50% or 60% of those FANG stocks, so it ain't going anywhere without it. Don't let it fool you. So again, be careful of the put-to-call ratio right now. Expect some mild upside. When I say mild upside, I'm talking about, let me show you where I think the S&P can go. Potentially go a little bit higher and then break down once again. So don't expect a miracle. Don't expect a move like this right now because, again, the number of stocks, the momentum levels are declining, and I wanted to show that out to you. Again, as far as news, as far as Fed data is concerned, not much on the table today. We've got wholesale inventories. We've got petroleum status reports. The energy sector has been doing really, really well. Actually, it has been leading the S&P 500 higher, and commodities tend to go higher when interest rates are low and money's cheap. Commodity prices, inflationary pressure, we're seeing that right now, and energies are participating in it quite well. I like the energy sector. I like the industrial sector. If you look at the stock fetcher code, you will see here, if you look at my scans, you will see here, hopefully it'll pull up. I've been having nothing but trouble with this lately. Let me see if I can get it working here. Nah, I guess it's stuck. Oh well, let's move on to what I wanted to show you was the fact that energy, basic materials, industrial, and real estate is what's topping things. But it doesn't want to go there. I don't know why it's not working right now, but it's not. Either way, that's where we're at right now. Let me give you a good preview of stocks I'm looking at. And I've been talking about this stock a while. I think I talked about it right here when it was at 83. Now it's at 89.90. But we talked about it right during this period, and I think it's going to go higher. CBRE. What does CBRE do? Very, very, very simple. Commercial real estate. The world is opening up, folks. There's no doubt about it. It is happening. Things are going back. Multifamily units, rentals, it's all starting to pick up again. Real estate operations. 61% return. Great stock. If you're on, I'm not sure about the East Coast because I'm not as familiar. I've only lived here about 3 years. But if you're on the West Coast and if you drive around Los Angeles, California, you'll see CBRE signs everywhere. I mean, this is one of the biggest commercial real estate brokers, dealers, owners in Los Angeles and in California. And I'm pretty positive other parts of the country. I just don't want to say it because I'm not as familiar with it around here. Next stock, Regions Financial. I like the stock. It's pulling back to the 50-day moving average. RSI is a little bit lower right here. It's coming off of swing highs, and it's a financial company. And if you look at what they do, you will see. It's a member of the S&P 500 index, one of the nation's largest full-service providers, consumer and commercial banking, financial, 61% one-year return. Both of these stocks, CBRE and RF, 61% one-year return, pulling back. I really like this stock. And another one is Berry Global Group, also pulling up to the 50-day moving average. If you look at what they do, you will see manufacturer, marketer of value-added plastic consumer packaging. Man, you've got double whammy here. Basic materials, right? Consumer packaging, engineering materials. I mean, what can I tell you, folks? This is it. One-year return, 35%. Let me see if I can. Let me see if I could pull this up here real quick for you. Let me see if I could. Nah, it's not working. I guess stock. I wanted to go through the sectors, but here we go. There we go. Saves the day in the end. So let me go through my filters. As you could see here, let me just kind of go through this with you. Energy, financial, real estate, basic material. Real estate, right? Financial, basic material, manufacturing, right? What could be better than that? Go for the low-hanging fruits. But technology, if you look here, let me go back a week ago. Technology was in 7th spot. Let me go back a month ago. Technology was in 7th spot. Today, technology is in 7th spot. But that's cumulative. Let's look at it on a monthly basis. 5th spot. So on a monthly basis, we got real estate, select sector, energy, communication sector, financial. But on a cumulative basis, energy, financial, real estate, and basic materials. And I'm always going by the cumulative, but I wanted to show you that over the last month, technology has been starting to move up. Again, I don't think this is going to be a huge move. I think it's going to be limited because we're overbought, because the put-to-call ratio is all the way up here. And quite frankly, even if we do break out on the bond market and we go higher, the truth is, I don't think we're going to go much higher than 149, which would only put interest rates at about 1.4, 1.3. Ultimately, I think before the end of the year, towards the end of the summer, as I've been saying, I think bonds are going to go lower, which means interest rates are going to go higher. Remember, there's an inverse relationship between the two. But keep your eye on the put-to-call ratio. That's very pertinent. And keep your eye out on CBRE, RF, Regional Finance, and Berry Global. I think these stocks, let me pull up Berry here. I think these stocks are going to go substantially higher. And when I say substantially higher, take it easy. They're not going to double in price, but they may go up 20, 30% over the next quarter. Now, folks, before I let you go, I've got some important, urgent, thanks to legendary trader Tom Busby, he's finally breaking his silence. Everyone now has the chance to grab winning trades and 3-day weekends, thanks to Tom, every week. Who would not like to start their week on a Tuesday? I'd love it. I'd love it, man. And remember, when you don't have positions on over the weekend, you can actually relax. You don't feel like there's something going on in the background. That's how I feel 24/7, because I'm always watching positions. So I always feel like mentally, I always feel like my floor is moving. When you have no positions on, you can relax. You can have a nice weekend, and you don't have to worry about overnight market risk. Something happens in Japan, China, who cares? You're in cash. Liquid, spendable cash. Now, Tom's discovered a way to tune out all of the noise in the stock market, and he explains how the same windows repeat every week, and he's delivered some of his best trades of the year. Check these out. I'm talking about 90% on Riot, 147% on FCX, 232% on Oracle. How can you afford not to be in on these, all right? It's a little Tuesday morning tip that tells them exactly which trades Wall Street could be pushing higher. In other words, it's all of the stocks that could explode within the next 96 hours. 4 days, 96 hours. In on Tuesday, out on Friday. Repeat after me. In on Tuesday, out on Friday. What could be better? Are you ready to find out how everyday traders just like you can enjoy long weekends without worrying about what will happen on Monday? Sign me up. Follow the link below and see how it's done. You do not want to miss this. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Folks, stay ahead of the market like this by being one step ahead when we post new videos. And have an amazing day, and keep your eye on that put to call ratio. It's getting a little too bullish. Talk to you later. Have a great day, and don't miss out on these trades. Tom has got it down to a science. I mean, 232% on Oracle on Tuesday, getting out on Friday. Who would not want that? Bye, guys. Follow the link below. You don't want to miss out. I'll see you later. Bye.